Good evening. Welcome to our Economics 330 Global Trade and Political Economy, City University of New York, MEC. Today is Tuesday, March 17th, 2026. And in the past 3 weeks, we have completed a three-part study of the three theoretical perspectives of global trade. And these include the liberal perspective, the realistic perspective, and historical materialism. This week, we will begin a three-part study of international trade relations and their components. And give me a second. Notably, yeah. So this week we will begin a new three-part study of international trade relations and their components. And these include one, international monetary relations, two, global trade relations, and three, regional trade arrangements. Now, international trade activities are driven by resource transfers, i.e., money. Therefore, one must understand the nature of international monetary systems in order to appreciate global trade relations. In a three-part study, 3 week, in a three-part 3 week study that begins this week or that began Monday, we will discuss the following: how nations relate to each other in the process of trade. For example, a country can limit the exportation of certain goods, or trade can be encouraged freely by one country but limited by another. We will also address the question, what are the reasons for tensions and conflicting differences in policy? One way of resolving conflicts will be to negotiate cooperation between nations and sometimes group of nations. Since this course is based on global trade and the political economy, we will discuss the mechanics of money and trade. Beginning with balance of payments, we will discuss how monetary flows affects the ability of a nation to transact international business with others. As an example, if a nation is unable to trade due to monetary limitations or imbalances that may be temporary, these may pose problems when they seek arrangements to help their temporary problems. This limitation could lead to long-standing or lingering inability to participate in global trade. And addressing this challenge through bilateral arrangements, i.e., one country versus another, rather than institutional support from, say, the IMF, may lead to political control of one country by another, which in turn could create international political issues within and between nations. Just right quick, what that means. If a country is suffering liquidity problems, it doesn't have money to finance its export and or support its budget, to find money to finance its import or support its budget, and it goes to borrow from another country instead of from a multilateral institution such as the IMF. You could quickly see how this can lead to a dependency and therefore coercion, potential coercion by the country that is lending to the borrowing country. So let us then begin with a brief overview of the evolution and history of international monetary relations. Historically, gold has been used as a reference point for currencies. The system of tying currency values to gold functioned quite well until the mid-20th century. The gold standard system in the early 1900s pegged the value of gold at 35 US dollars per ounce, which was the reference point other nations used in fixing the value of that currency. It is important to note that this price was not the commodity price of gold. In other words, if you went to the market and you wanted to purchase gold as an investment, that would not be the price you would pay. You would not be paying 35 US dollars per ounce. Indeed, private investors could not purchase gold at this price point. Government had exclusive rights over private individuals to buy gold at this below market price, thus reducing the volatility of currency values. But things changed fundamentally when the United States entered the Second World War and needed to finance the war effort. So in 1944, the US government pursued an expansionary monetary policy in a bid to financially support World War II efforts. Please note that expansionary monetary policy involves a reduction in taxes and an increase in government spending. Both measures are meant to stimulate the economy and increase the level of economic activity. However, this policy also caused inflation to rise and resulted in the US dollar losing value and fairly quickly. Obviously, if things are expensive, that means you're buying less stuff. Your dollar can purchase less stuff. For instance, just to break it down, and I hope should be common knowledge to everyone by this stage. But just to break it down, let's say a dollar can buy you 2 gallons of milk. And inflation comes that the price of a gallon of milk doubles. That means all of a sudden a dollar can only buy you 1 gallon of milk. And if you're a family that needs 2 gallons of milk, well, you got to look for a milk substitute, or now you got to pony up $2. So this is how inflation leads to a currency losing value because $1 could no longer buy what it used to purchase before the inflation. So consequently, other nations quickly began stockpiling gold to prevent fluctuations in their own currency. Eventually, this practice became quite unsustainable due to placing unrealistic demands on the inflation of the US dollar. Thus, in 1944, the gold standard was abolished and replaced with the pegged exchange rate system. I will circle back later in the lecture to further unpack the pegged exchange rate system, among other exchange rate regimes. Now that we have established a foundational overview, let us then transition to this week's learning objectives. Number one, learning objective number one, explain the term balance of payment or BOP and how this concept affects the ability of a country to participate in global trade. The answer is that a balance of payment, BOP, also known as the balance of international payments, is the difference in total value between payments into and out of a country over a defined period of time. Put differently, the BOP is the method by which countries measure all of the international monetary transactions within a defined period. The BOP, or balance of payment, consists of 3 main accounts. 1, the current account. 2, the capital account. And 3, the financial account. Note that the current account is meant to balance against the sum of the financial and capital account, but it rarely does. The balance of payment or BOP transactions consist of imports and exports of goods, services, and capital, as well as transfer payments, such as foreign aid and remittances into a country. A country's balance of payment and its net international investment position together constitutes its international account. Globalization in the late 20th century led to balance of payment liberalization in many emerging economies. Developing countries lifted restrictions on balance of payment accounts to take advantage of cash flows arriving from developed foreign nations, which in turn boosted their economies. Learning objective number 2, describe the International Monetary Fund, or IMF, and how it facilitates world trade. The answer is that the International Monetary Fund, or the IMF, founded in 1944, is a voluntary financial institution with a membership of about 184 countries. It fosters among these countries cooperative monetary policies that stabilize the exchange of one national currency for another. It thereby encourages international trade. The IMF provides a mechanism in which each member country can cooperate with the others to promote its domestic economic prosperity and that of the entire membership. The IMF maintains an extensive database of statistics on members' economies and on the world economy as a whole, which it shares with every member country. At the request of a member country, the IMF extends technical assistance in financial, fiscal, and economic matters. And this next point is crucial. If the IMF is persuaded that a member country is behind in payments to other countries, but is willing to implement reform policies, the IMF will extend facilities to tide over the defaulting member until the reforms take effect. Lastly, the purposes of the IMF are clearly expressed in Article 1 of its constitution, the Articles of Agreement, which includes, first, to promote international monetary cooperation through a permanent institution which provides the machinery for consultations and collaboration on international monetary problems. Second, to facilitate the expansion and balanced growth of international trade and to contribute thereby to the production and maintenance of high levels of employment, real income, and to the development of productive resources of all members as primary objectives of economic policy. Third, to promote exchange rate stability, to maintain orderly exchange arrangements among members, and to avoid competitive exchange rate depreciation. What that means is that you don't, again, the basic, all things being equal, the basic logic is this. If you have a weak currency and you're a manufacturing country, your goods would become less expensive in international markets if the value of your currency drops, right? And therefore, you're likely to sell more stuff. On the other hand, if you need to import, the cost of your imports will go up because now your currency has less value. Some countries can fall into the temptation of looking to officially downgrade the value of their currency to make their exports more competitive. And many have leveled this accusation against, no surprise here, China. So the fourth role of the IMF is to assist in establishment of a multilateral system of payments in respect of current transactions between members and in the elimination of foreign exchange restrictions which hamper the growth of world trade. The fifth role of the IMF is to give confidence to members by making the general resources of the fund temporarily available to them under adequate safeguards, thus providing them with the opportunity to correct maladjustments in their balance of payments without resorting to measures that may be disruptive to national or international prosperity. The sixth and final role of the IMF is that in accordance with the above, the IMF works to shorten the duration and lessen the degree of disequilibrium in the international balance of payment of member states. The third learning objective for the week is to explain how exchange rates are used to manage world trade by individual nations. And I got a little bit ahead of myself there, but let's unpack this. It is helpful to begin by differentiating between different forms of exchange rate, which include floating, fixed, and pegged exchange rates. Advantage of floating exchange rate currencies is that it can be traded without any restrictions. Unlike currencies with fixed exchange rates, hence, government and banks do not need to resort to continuous management processes in a floating exchange rate regime. Floating exchange rates enhance the efficiency of markets, especially as a country's macroeconomic fundamentals affect the floating exchange rate in global markets, influencing the flow of portfolios between countries. In a floating exchange rate, central banks are not required to maintain large foreign currency reserves for defending the exchange rate. Hence, the reserves can be utilized for promoting economic growth by importing capital goods. But again, considering dialectical thinking, there are also disadvantages to a floating exchange rate regime, as we have in the United States or most other advanced economies, especially the European Union. Disadvantages of floating exchange rates include that it is prone to fluctuations because, of course, it is the market demand and supply dynamics that determines the value of a currency in a float exchange rate regime. So, and this can lead to volatility potentially, especially as one currency's value against another currency may rapidly deteriorate in just one trading day. The lack of control over floating exchange rates can limit economic growth or recovery. Again, additionally, negative currency exchange rate movements may lead to serious economic challenges. As an example, if the dollar rises against the euro, US goods and services will become more expensive and, all things being equal, less competitive for exports into the Eurozone. If a country is suffering from economic issues such as unemployment or high inflation, floating exchange rates may intensify the existing challenges. As an example, depreciation of a country's currency in an economy already suffering from high inflation will cause inflation to increase further, thereby intensifying economic hardship due to reduced purchasing power. Additionally, expensive imports may worsen the country's current account. The next exchange rate regime is the fixed exchange rate, also known as the gold standard. It quantifies the value, a fixed exchange rate that is, quantifies the values of currencies by using a stable reference point. Historically, gold has been used as the reference point. This is because gold is a valuable commodity worldwide, and its value is less susceptible to fluctuations in interest rate. The next exchange rate regime is a pegged exchange rate system, which incorporates aspects of a floating and fixed exchange rate systems. Smaller economies that are particularly susceptible to currency fluctuations will peg their currency to a single major currency or a basket of currencies. These currencies are chosen based on which country the smaller economy experiences a lot of trade activity with, or on which currency the nation's debt is denominated in. Lastly, it is helpful to note that countries should have a macroeconomic growth strategy, a theory of growth. This may include a combination of A, an import-led economy, B, a domestic consumption-led economy, or C, an export-led economy. Although in theory of economic growth often incorporates elements of all three. So you hardly ever find an economy that is hardcore based on one philosophy of growth. It usually incorporates aspects of, but there might be a more dominant part of that. Like China is straight up the dominant economic growth strategy or theory of growth for China is export. So this concludes our formal lecture session. But before we transition into Q&A, please note that you will have 2 weeks beginning from next Saturday to complete your term paper, which will serve as your midterm exam. Accordingly, the due date for your term paper or midterm, should you choose to call it that, it will be or is 11:59 p.m. Saturday, April 11th. Please note that I will deliver an overview of the term paper midterm by next week, in addition to next week's Tuesday's lecture. Of course, I will, in addition to the addition to the post, the term paper. I will also post the term paper in addition to the lecture. I will also post the term papers guidelines on the Brightspace page. It is actually there, so it's already there in the in Brightspace. Actually, note that you can access and begin work on the term paper right now. Indeed, some of your classmates have already begun working on their term paper, but you just can't submit it yet because the submission portal is not open yet. Lastly, please note that next week's lecture will be on global trade relations. Having said that, I will now turn off the recording and take your questions, and I'll continue with office hour as necessary. Let's do this. Stop recording.